Swayam Prabha. Digital India. Educated India.
Hello everyone. So today's topic is alternative financing methods as part of the course Real Estate Finance and Investment Strategies. So first we'll talk about the learning objectives of this particular class. Identify the three main types of alternative financing methods. Compare mezzanine financing, bridge loans and hard money loans. Analyze when each alternative method is more appropriate. Calculate returns and cost for alternative financing structures. Evaluate the advantages and disadvantages of each method. Assess market trends and regulatory considerations in India. So, the question, what is alternative financing? So, alternative financing refers to real estate funding methods outside traditional bank mortgages designed for specific needs, timing constraints, or market gaps. Key characteristics include higher cost, faster execution, and flexible terms, and of course, specialized applications. Then, let's take them one by one. So, higher cost, we are saying typically they would be 2 to 10% above conventional rates. Faster execution, so days to weeks versus months here. Flexible terms, we are talking about customized structures, and they would be for the specific needs of the borrower. And where there is conventional lending, there is some gaps which cannot be addressed by the conventional lending. There specialized applications of alternative financing will be able to fill that gap. So, basically that is what we are talking about here in the alternative financing. So, in earlier lecture we saw that uh, mortgages for commercial real estate, mortgages for residential properties, they follow certain regular structure. But here we are talking about some alternative ways of financing, and there are some specific needs for which it is there. We will discuss what are these special cases, scenarios, and what kind of loans we are talking about, so that we will see. So, market gaps, what kind of market gaps we are talking about? So, market gaps include time sensitive opportunities, properties that do not meet conventional lending criteria. We have seen that we have certain types of ratios, and there can be situations when the businesses are not fit according to them, but will they not get any loan? So, the question arises like that, and of course, there are always option available. It's a much competitive market. So, these type of alternative financing modes that can then actually get open, and we have borrowers who have credit or income documentation challenges. Maybe the borrower has lower CIBIL score, there is income, but maybe the documentations are not available to show that kind of income which they are generating in their business. Then we also have the issue of capital stack optimization needs. So, that is another point. Then we have timing mismatches, which involves bridging purchase to permanent financing, then construction to permanent construction to permanent transitions or stabilization transitions or lease up periods. So, that is there. Then enhanced returns come from leverage optimization via maybe a mezzanine structure or strategic capital deployment. So, earlier we discussed about these commercial funding gaps. In this time, we are talking about alternative solution. Let's take one example. So, for example, a Mumbai office tower needs bridge loan to stabilize occupancy before bank refinancing. So, there comes in your alternative financing. So, with the rapid urbanization which we are witnessing is demanding such flexibility. So, that is there. Then we should move on to three main alternative methods. So, we have a mezzanine financing is a hybrid debt equity offering 14 to 20% return with equity participation used for 2 to 5 years of development projects. Then there is another type of bridge loans which provide short term funding at say 12 to 18% for 6 to 36 months, ideal for acquisition or transition. Then we have hard money loans are asset based, charging 18 to 36% for 3 to 8 months, suited for emergencies or distressed assets. So, earlier we were focusing on conventional loan, but these alternative addresses riskier, faster scenarios. For example, Hyderabad developer uses mezzanine for a mixed use projects, while a Goa hotelier opts for hard money. So, that kind of see, and you can also see that there is big difference in the rates, and these big differences in the rates are because of the kind of risk which is there and the kind of speed which is required for financing. So, some of them would want urgent finance with not enough paperwork and everything. So, of course, the lending would be at higher rate in comparison to other methods. And clearly, in all the three methods, you can see that from your conventional lending, there is a difference of rates which are being offered, which are very, very high in comparison to them. Then we have mezzanine financing fundamentals. So, let us explore that. So, it sits between senior debt of 60 to 70% and equity of 15 to 25% in the capital stack. Typically, 10 to 20% of project cost subordinated to senior debt, but senior to equity. In India, legal structures include non-convertible debentures, NCDs, preference shares. Then we have compulsory convertible debentures or alternative investment funds, AEIF. Pricing ranges from 14 to 20% base return, often with equity kickers. So, mezzanine basically add leverage for higher return. So, for example, a Bangalore mall developer uses NCD for last mile funding. This structure, balance risk and control, and is very appealing to India's developer. So, they like this kind of structure. Then we have one example here. So, consider a 100 crore mixed use development in Hyderabad, high tech city. First, the capital stack. So, 65 crore senior construction loan, 15 crore mezzanine, and then 20 crore developer equity, and terms 18% annual coupon, 12% is cash, and 6% is accrued. 20% of profit share above 22% developer IRR. So, that is being considered, and 36 months term. So, 2% we are taking as origination fees. So, this structure funds completion without diluting equity significantly. So, this kind of arrangement we can expect here. So, for example, Piramal Fund provides such financing for a project in Hyderabad. So, this kind of example you can see. Then coming to applications, so where it is being used. So, development projects use it to fill loan to cost gaps, then accelerate timelines or fund completion. Then coming to acquisition, leverage, mezzanine for value add properties or quick close deals. Recapitalization allows equity extraction, partner buyouts or dividend distributions. So, these are some things where we can see that in development projects we are talking about filling loan to cost gaps beyond senior debt limits, and accelerating the project timeline, which is becoming very important. There are bonuses attached to the project timeline. If government projects are there, sometimes they expect projects, if projects get over before time. And then we have last mile funding for project completion. Sometimes some projects at the end state require some extra funds to complete the project. They are finding it difficult. Once the project gets completed, everything will work smoothly, but the last mile funding is required. So, in such stages you will see this type of loan. Then leverage acquisition to enhance equity returns. Then value add properties requiring improvement capitals, and also for the quick close opportunities that require immediate funding. So, there also when some immediate business opportunity has come for acquisition, they may look for this. So, in acquisition also you will see that we have application of mezzanine fund, and then recapitalization. So, equity extraction while maintaining control. Partner buyout, sometimes partner wants to leave midway, there is some issue, and there also this kind of funding can take place. And dividend recapitalization for fund distribution. So, that may also may play out, that mezzanine may be useful. Then key players we are talking about. So, we have domestic AFIs like Kotak Realty Fund. We have Ask Property offers, which property which offers 15 to 75 crore deals. These type of domestic AFIs, they will be eager to give this kind of sums, and their expectations would be 16 to 20% IRR. And coming to private credit funds, so here you may see that we have Edelweiss, Piramal Fund Management, these type of private players. Their ticket size would be somewhere between 50 to 200 crores, and their expectation would be 17 to 22% return. And then we have international investors, whether we have KKR or Altigo Capital, and their large scale funding is there for them. It is 100 to 500 crore, and they focus on institutional quality a lot. And then sometimes there are players, family office players or HNIs also, who are jumping in this business, and they are individual wealthy investors, syndicated structures, and their ticket size will be small. So, they will be offering 5 to 25 crores, and they also expect higher return from these type of fundings. Then what are the advantages and disadvantages of this type of borrowing? So, for borrowers, we have reduced equity requirements, much less equity requirements, and maintain operational control. They can maintain their operational control. We have seen that in case of acquisition or in case of a partner leaving. So, these type of funds can come handy. And then faster execution, then JV equity, joint venture equity, and that is there. And then flexible prepayment options, which are here in this case, because the rate at which we are getting these loan are so high. So, flexible prepayment options are also available. Then there are certain disadvantages also. Of course, the first one, that it is higher in cost, very higher in cost than regular funding. We have seen that there is a significant difference between the alternative funding opportunity and the regular loan. So, there is a big difference between them, and the complex documentation and inter creditor agreements, and then of course restrictive covenants are also here, that there are because the lending authority or lending party is actually taking lot of risk. So, the covenants are also much more restrictive, more stringent guidelines, and there in the contract documentations between the two parties. And there is a potential control loss in case of default scenario. So, sometimes they are so stringent that they may lose their own ownership in such scenarios. So, that is also there, that risk is also significantly higher. And then we talk about advantages and disadvantages. So, there has to be a risk return profile. So, moderate risk with enhanced returns, there can be situation that this is a moderate risk, but it can give immense returns because it is giving you quick funding. Then downside protection through security package, that can be there, and upside participation through equity kicker. So, there can be these type of risk return profile which can be built. Then we have to go to bridge loan fundamentals. So, bridge loans are short term solutions. Their core purpose is to bridge funding gaps until permanent financing or property sale. So, their terms are also small, so 6 to 36 months. Most common are typical 12 to 24 months, and rates are 12 to 18%. LTV is around 60 to 70%, 75% depending on property type, and the structure is typically interest only with the balloon payments. So, exit strategies include refinancing with the conventional bank loans. That is what it is doing, that is, it is bridging the gap. And then we have also the option of property sale to come out, and operational cash flow, which can be rare in these circumstances, because generally we are looking for either permanent financing or property sale after a particular stage. So, that is what we are going towards. So, cash flow suddenly coming back is a little difficult. Example would be a Mumbai developer using a bridge loan to acquire a office building. So, refinancing later. So, that can be the situation, that they are temporarily using this loan instrument. And the focus in this kind of arrangement is short term. That is, the short term, in the short term we are trying to just go by. We want to continue our workings, and that is what it is trying to provide, a kind of continuity in the business. Then we come to type of bridge loans. So, bridge loans, we have acquisition bridge loans. So, we are talking about a LTV of 60 to 70%, and term will be 6 to 18 months. This kind of loan will enable quick purchases in competitive or distress scenarios. Construction completion bridge loans will be another type, and here the LTV would be somewhere around 60 to 65 to 75% and of completed value, and it will basically fund the stalled projects, the projects which have stalled, got stuck due to financing issues, and so that is there. Then we also have these lease up bridge loans. So their function is finance properties during stabilization, the transition to permanent financing once stabilized, and term often is 12 to 36 months. So transition to permanent financing through lease up bridge loans. And then we have inventory monetization loans, which LTV is somewhere around 50 to 60%, and basically liquidate unsold units. If there is a pile up of unsold units, this can help us in unloading them. So that kind of funding we can use. So this is there, and basically the purpose here is that we are reducing the principal as unit sell. So we are waiting for some, maybe for a festive season to start, and we know that once festive season or some particular opportune time will come, and people will start buying our units, then maybe we will have enough funding. But right now we want to reduce this principal amount. So basically we are going for this kind of loan. Then example for bridge loan. So consider a 50 crores office acquisition in Mumbai's BKC, currently 60% occupied, with a status renovate and release to 90%. So bridge loan of 35 crores, that will be at a LTV of 70%, 14% interest only rate, and 18 months with 6 months extension is the term, and the fees will be 2% originator fee and 1% extension fee, and the exit will be bank refinancing at 90% occupancy. So that is the aim. There will be exiting. So this kind of we are talking about. So this kind of fund loan will be Edelweiss might be funding some Mumbai deal. So there would be this type of scenarios which might prevail there. Then we come to bridge loan providers in India. So we have seen earlier for mezzanine, now we are looking at bridge loan. So many players will be similar. Then for NBFC, we have some major players in this area like Piramal Capital, Leader, Edelweiss, IIFL, Tata Capital, and size will be 5 to 150 crore. Processing time would be 3 to 4 weeks, and you can expect rates of 12 to 16%, and the focus will be mid to large projects. Then coming to private credit funds, so Kotak Realty, we have HDFC Capital, and size will be 20 to 200 crores, and processing will be of 2 to 3 weeks, and rates 14 to 18%, and these would be complex transactions, and there would be some value adds. So it might not just be simple 14-18%. There can be other additions to that in terms. And then we have HFCs. So we have LIC Housing Finance, PNB Housing Finance, and their size will be of around 5 to 50 crores. Focus will be of course residential projects, and the rates would be of 12 to 15%, and they will be of course going for conservative approach in these rates. And then we have seen earlier also that there is a category of HNIs or family offices. They also are now in this business, and the relationship based lending will be there. Generally, they lend to people whom they know. So, they try to go for smaller ticket sizes and higher rates, and people who they can rely, they have heard of their names, and such type of personal connection also play a crucial role in such type of loans. And generally what happens is that if institutions are not willing to lend you, then you go for such type of alternatives. So, we can see that rates are of course higher here, and it is 15 to 20%, and size is also not very significant, it is 3 to 25 crores. Then we come to bridge loan applications, how they will be there. So, what are the applications of bridge loans? So, we have auction purchase acquisitions, we have project completions, we have time sensitive acquisitions, and we have project completions, we have refinancing strategies, and we have value add transitions. So, in time sensitive acquisitions, we can see that we have auction purchases requiring quick funding. We have competitive situations needing execution certainty, and opportunistic distressed property purchases. And then project completion, so last mile funding for stalled construction. So, this happened in infrastructure many times, that there were certain projects which started, but because of some situations which happened during the long construction period for infrastructure, by the time they reached to the ending stages, they were short of fund, and because of that shortage of fund, the whole project got stalled. And in those type of scenarios, you require this bridge loan. So, there also we are talking about bridge loan. And then cost overrun coverage. So, there can be situations where cost overrun is there, and then timeline extension funding. So, sometimes timeline has to be extended, and that will be requiring more fund, maybe because of some reasons we have not adhered to timeline. And then refinancing, maturing loan replacement. There is a loan which is getting matured, and we have to pay back, or we have to make temporary arrangements. Then lender relationship transition also can be there, that we have looking for another lender, and in midway we want to have a funding option. So, that way we can go for these type of loans. Then distress debt resolution also, that where the situation is over distress, company is in very dire situation, and they want to come out of it, and they are looking for bridge loan. And properties requiring repositioning, that can also be the case. And then major innovation or upgrade periods, or tenant mix optimization requirements are there. So, maybe for that we are looking for bridge loan. So, there are different such situations in which we might be applying bridge loan. So, then we have hard money loan fundamentals. So, hard money loans are asset based. They prioritize collateral value over borrower's credit, offering 3 to 10-day funding. So, the period is very small, 18 to 36% monthly rates, 1.5 to 3% per month, that is significant, and 50 to 75% LTV, 3 to 8 month term typically, and minimal documentation. So, focus is on property value. We can see that speed is very fast, 3 to 10 days we can apply, we can get. Rates are very significant, 18 to 36%. Terms are typically smaller, 3 to 18 months. So, that kind of scenario we are talking about. And these are based on collaterals. So, collateral has to be given. And documentation, as we can see, are minimal, basically property title and basic KYC of the entity who is taking the who is the borrower. And the primary focus will be property value and clear exit strategy here rather than cash flow analysis. So, that is what the idea is, that the collateral is the main issue, and if that is clear, the loan can be given. But of course, these are short term loans with higher rates, and the processing is also very quick. Then we go to hard money loan types. So, we are talking about niche needs. So, basically residential loans. So, 10 to 5 crore size residential property loans, quick financing against homes and apartments. Against homes and apartments, we are getting this. Sizes can be of 10 to 5 crores, and the point is that the speed is very fast here. Usually, business needs are there or urgent liquidity is required, maybe for personal reasons, but mostly for the business needs. Then we go to commercial property loans. So, rapid financing against office retailer properties. So, size can be 50 lakhs to 10 crores, and higher rates due to the complexity. And then we have land loans. So, most conservative due to development risk. Then we have LTV of 40 to 50% here, and rates are 24 to 36%. And uses will be, of course, acquisition opportunities and holding cost. And then we have construction emergency loans. So, here emergency funding basically for stalled projects, and bridge kind of bridge until conventional financing is arranged. So, that is some different type of loan types for hard money loans. So there can be different situations where such fast loans are required, but the idea is that in every area there has to be some collateral. So, whether it is a land, whether it is office, or whether it is residence, so there has to be certain collateral, and then only these type of loans can be availed. Then we come to one example here. So, we have a distressed hotel in Goa, has 15 crore market value, but a 10 crore sale price, requiring a 7-day close. Now, hard money loan here is 5.5 crores, 55% of purchase price, 24% rate, 2% monthly is there, and term is 6 months. 4% is origination fees, and that is around 22 lakh, and the exit is bank refinancing after stabilization. So, once this whole process is stabilized, then refinancing it will be done. So, total cost is 66 lakh interest plus 22 lakh fees is equal to 88 lakhs for 6 months. So, in all, this type of loan can become very good proposition for all the parties, because here somebody wants to sell their hotel quickly. There are not many buyers, and the buyer has approached institution, and they are offering this loan 5.5 crores, and the rates are also very high, and this way this person can sell their hotel, and the borrower is able to buy it. Meanwhile, they were looking for stabilization situation. Once the stability is achieved and bank refinancing at normal rates are achieved, they will go with this process, and ultimately they will acquire. So, this is a kind of quick method to come out of this situation. So, these are the like this is a good example of that. Then hard money providers who are basically into this business. So, we have organized private lending platforms. So, professional operations with standardized processes. They have their own website, they have their own process created. Their sizes would be 25 lakh to 10 crores. And rates would be 18 to 30%, and processing would be 3 to 7 days. Very quickly, on the basis of hard assets, they will give you the loan. Then HNI networks, they are like some group of high net worth individuals. So, they will give 10 lakh to 5 crore range of loan. Rates will be of course 24 to 36%, and very fast decisions will be taken. Then we have modernized traditional lenders from former informal lenders with professional practices. So, their sizes would be 5 lakh to 2 crores, and rate would be 24 to 48%, and same day decision is possible. Then we have real estate investors, investors who lend as part of deal flow strategy. Size would be 50 lakh to 10 crores, and sometimes include equity participation option also. They might go for equity participation also in this particular venture. So, this is the type of providers of hard money loan. Then the application of this loan. So, extreme time sensitivity, auction purchases with the 3 to 7 day payment requirement is there. Competitive acquisition requiring immediate funding, that the example which we saw, we were looking for that hotel example. And then emergency capital to prevent foreclosure. So, there can be this bank is standing on the door, or the some other funding agency, and so that meanwhile they arrange for proper loan. They are looking for this hard money application, hard money loan, so that can somehow they can clear the waters and move forward. Then credit challenge scenario. So, recent bankruptcy or credit event has happened. So, there they might want to go through that phase. Then temporary income disruption is there due to some situation like we had during COVID-19. Then foreign nationals with the limited credit history. So, they are not here, and they are from outside, and they want to avail loan quickly. So, we have seen earlier that when it's foreign nationals or NRIs, there is a stringent paper requirement, proper documentation and everything, and because it's not easy to get back your loan if somebody is trying to cheat bank, then in that case, so bank also take a lot of time. So, in such scenarios also hard money loans can become very useful. Then unconventional properties. So, properties with title or approval issues. There can be unique assets difficult to finance conventionally. Nobody is willing to finance them. So, they might go for this. And then properties requiring immediate improvements. So, once this is done, it can be sold to somebody else, but nobody is willing to finance that, and hard money loan can then work for that. And then there can be emergency capital needs also. So, prevent loss of much larger equity position is the aim. So, that can be fulfilled through hard money loan. Somebody will lose their equity position. Sometimes what happens is that people have for the loan, they have put their equity in a company as collateral. So, they can lose that also. So, for safeguarding that, they may go for these. Then a business emergency requiring immediate liquidity. So emergency of business is there, and immediate liquidity if infused, it can save the business. So there also this type of loan can come in. And tax lien resolution. So if there is a tax demand or something and immediately fund is required, so there also these type of loans might be useful. Then let's have a comparison of all the three type of alternative uh, investment, alternative loans we have discussed. So we can clearly see that hard money is the highest interest rate, but quicker, very quicker in comparison to mezzanine or bridge loan. Fees are also high in hard money, and that is there. And in term, this is for 3 to 18 months, hard money. Bridge loans can be for a longer period, 6 to 36 months. And mezzanine, of course, can be for much larger period of 2 to 5 years. And total annual cost will, of course, be highest for hard money in comparison to mezzanine, as you can see here. Also, something which is observable, that the kind of institutions who are giving these loan. So we have seen that we have alternative investments funds who are working in this area, but in hard money mostly it is smaller players or not institutional players, which we saw in earlier two loans. So that kind of difference is also visible. So hard money is of course the quickest, but of course the most costliest also. Right. Then we talk about the optimal use cases. So when we need long-term capital, we go for this mezzanine. Long-term capital, 2 to 5 years, want to minimize equity dilution, have complex development projects, seek strategic investor partnership. So they are looking for partnership kind of arrangement where the capital infusion is the need of the hour. So that is there. They want to minimize equity dilution. So this is the kind of arrangement a company can go for. Then bridge loan, when have 6 to 36 months exit strategy, they want to look out for some exit, and this is the way they this bridge loan is the way they can go for. Then need moderate term gap financing. So gap financing, they are looking for um, senior loan, and they are looking for a moderate gap filling kind of arrangement. And phase timing mismatch with permanent loan. So there is a mismatch with permanent loan, and that they can temporarily have these arrangements. And require transition funding during repositioning. They are trying to reposition, and during that they are trying to fund. So when the case will be for hard money, need funding within days, like we had seen that acquisition example of Goa hotel, and face extreme time pressure. There is this competition between maybe different buyers for the same asset, and they all are looking for some quick way to get it. And so time is there, small time is there, and have credit or documentation challenges. Documentation will take time. Creditworthiness might not be there for such investors, so they might be going for this. And then require emergency capital preservation. Maybe there is a need that there is a foreclosure or some kind of event about to happen, and they immediately require emergency capital for that. So then we come to risk return profile. So risk in mezzanine is moderate, subordinated but secured, 16 to 22% IRR with the equity upside that is there, and liquidity is low, 2 to 5 year hold period. Bridge risk is moderate to high, depends on the exit strategy, and return can be somewhere between 14 to 20% for lenders, and liquidity will be medium. Hard money risk is high, of course, market volatility, short term, very short term loan, and return can be 24 to 40% to compensate for risk, and liquidity is high in this also. So, that is the risk return profile for these type of loans. Then coming to combined strategies. So, layered capital stacks here using multiple alternative methods simultaneously. So, for example, 200 crore development, we have a senior debt of 120 crores, mezzanine of 30 crores, bridge equity of 20 crores, and developer equity is also there of 30 crores. So, this is 60, 15%, 10% and 15%. And we have sequential financing. So, different methods at different project phases. So, acquisition we may go for hard money because the speed is important there. Quickly acquisition has to be done, otherwise the opportunity we will miss out on that. And during development we may go for bridge plus mezzanine because we might be looking for some alternative arrangements. Before that we go for these alternative funds in between. And then stabilization, we might be refinance to conventional after some time. Once we are stabilized, we will refinance to the conventional mode of funding. Then regulatory considerations here. So, SEBI AIF regulation for fund structures is there for mezzanine. Then FDI compliance for foreign investors. So, foreign investors, if they have to be FDI compliant. And then Companies Act provisions for debenture structures. So, all this has to be properly regulated. So, new regulations in AIF have been formed by SEBI and they are regulating this. Then we have bridge loans. So, RBI guideline for NBFC lending, they will operate here. And we have this SARFA ESI Act for enforcement mechanism. So, that will also be there for proper regulations in this area. And of course, there will be state wise stamp duty variations also from one state to another state, and some state might be more conventional in their approach, and some may go for the the specific rules they have formed for such loans. Then going on to hard money loans. So, money lending licensing requirements will be there. Because like we discussed earlier, there are small operators in this particular business, not institutionalized players. Then usually law limitations in various states are there. There are certain limitations to this kind of law, this kind of loans. And then we have anti-money laundering compliance, because this can sometimes be misused and might be illegal. So, that has to be controlled properly. So, anti-money laundering compliance issues might also be checked in this area by regulators. Then key impact will be regulatory complexity, which will increase with sophistication. So, the kind of arrangements, these new type of funding options are there, they will require specific type of regulations, and regulators are also trying to keep up with them. Then market trends in this area. So, in mezzanine we can see 35,000 to 45,000 crores outstanding. Big market is emerging here. Bridge loans, we can see that is also a big market of 75,000 to 85,000 crores. And hard money, again 20,000 to 25,000 crores. This is something which is organized. There might be an unorganized area also, which is not well accounted for and might not be properly regulated. And then there is some emerging trends. So, technological integration, now AI underwriting, digital platforms are coming up with more HNIs and financial institution, private and financial institutions coming up. They are using these newer and newer technologies, and with lower manpower they are able to enter into these areas, these businesses. And then ESG focused products with preferential terms. So, some foreign funding agencies are always looking towards ESG focused products. So that is becoming important trend. Then increased institutional participations can also be viewed here. And then product standardization with innovation, new innovative products are being launched. And then growth projection, so 15 to 18% CAGR across alternate methods, fast emerging, quickly developing area. Increasing market sophistication. Market sophistication in these areas are increasing with the advent of fintech. This is improving day by day. And then better integration with traditional financing. So now even some financing authorities which were not very excited about this area, now even they are looking at it, and they are becoming better integrated with the current players. Maybe in future you will see that the conventional players are also entering in these areas. Then we can see the technological impact here. So digital lending platform reducing approval time. This is something which we are observing across the board. AI enhanced underwriting for better risk assessment. So a lot of AI integration is taking place here. And blockchain application for documentation, for the safeguard of the documentation, safety and security, that is being looked into. And then virtual due diligence capabilities are also being developed. Future development, we have predictive financing platforms, autonomous transaction systems, dynamic pricing models, and comprehensive digital asset representations. These are some future developments which are panning out. From dynamic pricing, which we have seen, we have seen that predictive financing platforms, now these platforms will also predict, will be able to better predict what are the possibilities of future for these type of real estate ventures who are coming for loan. And then benefits, there will be faster processing, days instead of weeks. Now, right now we are talking about AIF because time is of essence. They are looking for weeks in comparison to the conventional lending of months, but maybe in future that will happen in days. So this kind of scenario is developing, and maybe very shortly we will see that from weeks to days will come. And then lower cost through automation, better risk assessment through data analytics, and improved transparency and reporting will also take place. Now, there are certain practical decision framework which we have to see here. So, timing requirement, how quickly do you need funding? What's your exit timeline? Cost tolerance, what total cost of capital is acceptable? How does this compare to alternatives? These are some questions regarding cost. Then risk assessment, what's your comfort with higher leverage? How certain is your exit strategy? And strategic objectives, do you want to maintain control? Is relationship value important beyond capital? So these are some important questions which needs to be addressed while both availing and by giving these loans. So these are some practical decision framework which should be thought about in these alternative investment funds. Then a case study comparison. So same property, different methods. So scenario, 10 crores office building acquisition, available equity is of 4 crores. Option A is mezzanine, bank loan of say for example 6 crores plus mezzanine of 2 crores. Total cost 16% blended rate. 3-year term, equity is getting preserved here. Option B, bridge loan, 7 crores, total cost 15% for 18 months. Quick execution, refinancing is then required. Option C will be hard money, 5.5 crore, total cost 26% for 6 months, fastest execution, highest cost. So how you actually look at a particular loan scenario is comparing them and deciding which is the most suitable for your needs. So that is something which we can see here. We have 3 different options, and as per the requirements of the borrower, they will have to decide on the best suitable options for them. So, key success factor. So, for borrower, clear understanding of true cost and risk, realistic exit strategy planning because loans are very costly, strong relationship building with providers because there can be situations where they might face difficult times ahead also, and comprehensive preparation and documentation. So, these are some good things which borrower should remember. And for the market, continued regulatory framework development, technology adoption for efficiency, transparency in pricing and terms, integration with traditional ecosystem. So, this is the existing market we are talking about. They should be integrating with these new alternative options, and the alternative outlook is alternative method becoming more mainstream. Better integration with conventional financing is something which we can see in future, and increased sophistication and standardization is something which will be visible. Key takeaways: strategic tool, alternative financing method are specialized tools for specific situations. Cost benefit trade-offs: higher cost can be justified by speed, flexibility or access to opportunity. Proper selection: match the financing methods to your specific needs and timeline. Risk management: understand both the benefits and risk of each approach. Market evolution: alternative financing is becoming more sophisticated and accessible. Professional guidance also, which was there, complex structure benefits from experienced advisors, and there are very big decisions to be made. So, professional guidance is must. Then bottom line, alternative financing expands possibilities but require careful analysis because it is a very risky trade-off. So, with this key points which we have discussed right now, we can go to the questions for self-assessment. What are the typical LTV ratios for each alternative financing method? You can think about this. You can think about all these questions and ponder over it, that like when you go through these questions, you understood this whole concept. The answering these questions will help you in that. So, you can go through all these questions, and then next you will be able to better understand this area. So, with this I would like to thank you.